Something extraordinary just happened in the gold market. And if you're not paying attention, you're about to miss one of the most significant wealth transfers in modern history. Central banks around the world are doing something they haven't done at this scale in decades. They're accumulating gold at a pace that should make every investor sit up and take notice. We're not talking about modest purchases here. We're talking about a coordinated global movement that's reshaping the entire precious metals landscape. Let me paint you a picture of what's actually happening behind the scenes. For years, central banks were net sellers of gold. They viewed it as a relic, something from a bygone era that had no place in modern monetary policy. But something changed, and that change accelerated dramatically over the past few years. Global official gold reserves have surged to record levels. Central banks aren't just buying gold anymore, they're hoarding it. And the pace of accumulation is accelerating, not slowing down. Think about what that means for a moment. These are the institutions that control the money supply. They have access to information and intelligence that you and I will never see. They understand currency dynamics, geopolitical risks, and economic cycles better than almost anyone. And they're choosing to convert their paper assets into physical gold at unprecedented rates. Why would they do that? Let's start with the obvious answer. Trust in the dollar-dominated system is eroding. Not collapsing overnight, but eroding steadily, like water wearing away stone. Every sanction, every frozen asset, every geopolitical conflict chips away at the foundation of dollar hegemony. When Russia's foreign reserves were frozen, every central bank in the world took notice. If it could happen to Russia, it could happen to anyone. Gold can't be frozen. It can't be sanctioned. It can't be devalued by a keystroke. It's the ultimate neutral reserve asset. But there's more to this story than just geopolitical insurance. The BRICS nations have been particularly aggressive in their gold accumulation. China, Russia, India, Brazil, and now an expanding list of countries are building gold reserves while simultaneously reducing their dollar holdings. This isn't random. This is strategic positioning for a new monetary order. China's official gold reserves have been climbing steadily, though many analysts believe their actual holdings are far higher than reported. The People's Bank of China has been adding to reserves month after month, and they're not alone. The Reserve Bank of India has been a consistent buyer. Turkey's central bank has been accumulating aggressively. Poland, Singapore, Qatar, the list goes on. These aren't small players making symbolic gestures. These are major economies making strategic decisions about the future of their monetary systems. Now here's where it gets really interesting. The gold market operates on two levels. There's the paper market, where contracts and derivatives trade in massive volumes on exchanges like the COMEX. And there's the physical market, where actual metal changes hands. For years, the paper market has dominated price discovery. But something is shifting. Physical demand is starting to overwhelm paper supply. When central banks buy gold, they're not buying futures contracts. They're taking delivery of physical metal. They're draining it from the system. The London Bullion Market Association, the LBMA, is the heart of the physical gold market. And the dynamics there are changing. Spreads are widening. Delivery times are extending. These are signs of stress in the physical market, signs that demand is outstripping readily available supply. Think about the mechanics of this for a moment. Gold mining production is relatively flat. It takes years to bring new mines online. Recycling provides some supply, but it's limited. Meanwhile, central bank demand has surged to levels not seen in decades, and they're competing with investment demand, jewelry demand, and industrial demand. Something has to give. The price of gold has been climbing, but many analysts argue it hasn't climbed nearly enough to reflect the fundamental supply-demand imbalance that's developing. The paper market has been keeping a lid on prices through massive short positions, but physical demand is starting to overwhelm that dynamic. Let me tell you a story that illustrates what's happening. Back in the early 1970s, when Nixon closed the gold window and ended dollar convertibility, gold was trading around $35 an ounce. Within a decade, it had surged to over $800. That wasn't just inflation. That was a fundamental repricing of gold's role in the monetary system. We might be at a similar inflection point right now. The difference is, this time, the repricing is being driven not by individual investors panicking out of dollars, but by central banks systematically repositioning their reserves. And here's what most people don't understand. When central banks buy gold, they're not doing it to make a profit. They're doing it to preserve purchasing power and maintain monetary sovereignty. They're willing to hold through volatility because they're thinking in decades, not quarters. That creates a one-way demand dynamic. Gold that goes into central bank vaults tends to stay there. It's not coming back onto the market when prices rise. It's being removed from circulation permanently. Now, if you're sitting on significant retirement savings, this should matter to you. The same forces driving central banks to accumulate gold apply to individual wealth preservation. Currency debasement, geopolitical instability, financial system fragility. These risks don't discriminate between institutional and individual wealth. Quick aside here. If you have $100,000 or more in retirement accounts, I've put together a comprehensive guide on how gold IRAs actually work. It's in the description below. It covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, the custodian requirements, the storage considerations, all the details you need to make an informed decision. Worth checking out if wealth preservation is on your mind. Anyway, back to what's happening in the broader market. The gold accumulation by central banks is sending ripples through the entire precious metals complex. Silver is starting to move in sympathy, though it's lagging gold's performance. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been elevated for years. Historically, when that ratio gets stretched, it eventually snaps back, and silver outperforms dramatically. But let's stay focused on gold for now, because the central bank story is far from over. One of the most fascinating aspects of this accumulation is how quiet it's been. You're not seeing headlines about it every day. You're not seeing panic buying by retail investors. This is institutional, strategic, and largely flying under the radar of mainstream financial media. That's actually typical of major market shifts. By the time everyone is talking about it, by the time it's on the cover of magazines, the big move has already happened. The smart money, the institutional money, the central bank money, they're positioning now, while most investors are still debating whether gold is relevant in a modern portfolio. Let me give you some context on how gold fits into the broader economic picture right now. We're living through a period of unprecedented monetary expansion. Central banks around the world printed trillions in new currency over the past several years. That money didn't disappear. It's sloshing around in the financial system, inflating asset prices and eroding purchasing power. Gold is the traditional hedge against currency debasement. It's not a perfect hedge, and it doesn't move in a straight line. But over long periods, gold has maintained its purchasing power, while fiat currencies have lost value. That's not speculation. That's historical fact. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. Gold hasn't. An ounce of gold today buys roughly the same amount of goods and services it bought a century ago. That's the power of a monetary asset with no counterparty risk and limited supply. Central banks understand this. They've always understood this. What's changed is their willingness to act on that understanding by converting paper reserves into physical metal. Now, there's another dimension to this story that doesn't get enough attention: the geopolitical dimension. Gold accumulation is part of a broader strategy by many nations to reduce dependence on the dollar-based financial system. It's not just about hedging currency risk. It's about creating alternatives to dollar hegemony. When countries trade with each other, they typically settle in dollars. That gives the United States enormous power because it controls the currency that facilitates global trade. But what if countries started settling in gold instead? Or in currencies backed by gold? Or in a basket of currencies with gold as a component? These aren't hypothetical questions anymore. These conversations are happening at the highest levels of government in countries around the world. The BRICS nations have been discussing alternative payment systems. They've been discussing commodity-backed currencies. They've been discussing ways to bypass the dollar system entirely. Gold is central to all of these discussions because gold is the one asset that every country recognizes as valuable. It's the universal money, the asset that transcends borders and political systems. This is why central bank gold accumulation matters so much. It's not just about portfolio diversification. It's about the architecture of the global monetary system. And that architecture is shifting in ways that favor gold. Let me walk you through what this means for prices. If central banks continue accumulating at current rates, and if investment demand picks up as more investors recognize what's happening, and if industrial demand remains steady, where does the supply come from? Mining production is relatively inelastic. You can't just turn on a switch and produce more gold. It takes years of exploration, permitting, development, and construction to bring new supply online. And even then, the ore grades are declining. Miners are having to dig deeper and process more rock to extract the same amount of gold. Recycling can provide some supply, but it's limited by the amount of gold jewelry and other items people are willing to sell. And at current prices, recycling flows are modest. That leaves existing above-ground stocks. But here's the problem. A huge portion of above-ground gold is held by central banks, and as we've established, they're not selling, they're buying. Another large portion is held in jewelry form, particularly in countries like India, where gold has deep cultural significance. That gold doesn't come to market easily. The remaining gold is held by investors, either in physical form or through vehicles like ETFs. Some of that gold will come to market as prices rise, but probably not enough to satisfy the demand we're seeing from central banks alone, let alone total demand. This is what's called a structural supply deficit, and structural supply deficits tend to resolve through higher prices, sometimes much higher prices. Think back to the period from 2008 to 2011. Gold went from around $800 an ounce to over $1,900. That was driven by a combination of factors: quantitative easing, sovereign debt concerns, currency debasement fears, but the underlying dynamic was similar to what we're seeing now. Demand overwhelmed supply, and prices adjusted. We could be in the early stages of a similar move. The difference is, this time central banks are leading the charge, not following retail investors. That's actually more bullish, because central bank demand is more persistent and less price-sensitive than retail demand. Now, I want to address something that skeptics often bring up. They say gold doesn't produce cash flow. It doesn't pay dividends or interest. It just sits there. Why would you own an asset that doesn't generate income? That's a fair question, and it deserves a thoughtful answer. Gold isn't an investment in the traditional sense. It's insurance. It's a store of value. It's a hedge against the debasement of paper currencies and the instability of financial systems. When you own stocks, you're taking on business risk. When you own bonds, you're taking on credit risk and interest rate risk. When you own real estate, you're taking on market risk and liquidity risk. Every asset has risks. Gold's risk is opportunity cost. The risk that you could have earned a higher return in something else. But gold's benefit is that it has no counterparty risk. It can't default. It can't go bankrupt. It can't be inflated away by a central bank printing press. In a portfolio context, gold serves as a diversifier and a tail risk hedge. It tends to perform well when other assets are struggling. It provides stability during periods of financial stress. And over long periods, it preserves purchasing power. Central banks understand this. That's why they hold gold. Not to generate income, but to provide stability and optionality in their reserve portfolios. And right now they're increasing their gold holdings significantly. That tells you something about their view of the risks facing the global financial system. Let's talk about those risks for a moment. We're living in a world of record debt levels. Government debt, corporate debt, household debt. It's all at or near all-time highs relative to GDP. That debt has to be serviced, and in many cases it can only be serviced through currency debasement. When governments can't raise taxes enough to cover their spending, and they can't cut spending without political backlash, they resort to printing money. That's monetary history in a nutshell. And it's happening right now on a global scale. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, they've all massively expanded their balance sheets. They've all printed trillions in new currency. And while they talk about normalizing policy and reducing balance sheets, the reality is that debt levels are so high that any serious attempt at normalization would crash the economy. So they're trapped. They have to keep the printing presses running, at least to some degree. And that means continued currency debasement. And that means gold becomes more valuable over time, not less. Central banks in emerging markets understand this better than anyone. They've lived through currency crises. They've seen what happens when confidence in a currency evaporates. They're not going to let it happen to them again if they can help it. And the way they're helping it is by accumulating gold. Now, here's where the story gets even more interesting. The accumulation isn't just happening at the central bank level. Sovereign wealth funds are also increasing their gold exposure. These are the investment arms of governments, managing hundreds of billions or even trillions in assets. And they're allocating more to gold. Why? Same reasons as central banks. Diversification, tail risk hedging, concern about currency debasement and financial system stability. But also because they're seeing the same signals everyone else is seeing. Geopolitical tensions rising, debt levels unsustainable, monetary policy trapped, and gold is one of the few assets that benefits from all of these trends. The Chinese Sovereign Wealth Fund has been quietly accumulating gold. Middle Eastern sovereign wealth funds have been doing the same. These are sophisticated investors with access to the best research and analysis in the world, and they're choosing gold. That should tell you something. Let me give you another historical parallel. In the late 1970s, gold went from around $100 an ounce to over $800 in just a few years. That move was driven by inflation fears, currency instability, and geopolitical tensions. Sound familiar? The difference between then and now is that back then, central banks were selling gold, not buying it. They viewed it as a barbarous relic, to use Keynes's famous phrase. Now they're accumulating it aggressively. That's a fundamental shift in how the official sector views gold's role in the monetary system. And if central banks are shifting their view, shouldn't individual investors be paying attention? The gold market is relatively small compared to other asset markets. The total value of all above-ground gold is around $15 trillion. That sounds like a lot, but it's tiny compared to global stock markets, which are worth over $100 trillion, or global bond markets, which are worth over $130 trillion. What that means is that relatively small shifts in allocation can have outsized impacts on gold prices. If just a small percentage of global wealth shifts into gold, prices could move dramatically. And that's exactly what we're starting to see. Not a flood of money into gold, but a steady, persistent accumulation by the smartest, most informed players in the market. Central banks, sovereign wealth funds, family offices, institutional investors. They're all increasing their gold exposure. The retail investor, the individual saver, they're largely sitting on the sidelines. They're still debating whether gold is relevant. They're still listening to financial advisors who tell them to stick with a 60-40 stock bond portfolio. They're missing what's happening right in front of them. But that's actually typical. Retail investors are usually the last to recognize major market shifts. By the time they pile in, the big move is often over. The smart money, the institutional money, they're positioning now. And the smartest money of all, central bank money, is going into gold at a pace we haven't seen in decades. Now, let's talk about what this means for the price trajectory going forward. If central banks continue accumulating at current rates, we're looking at hundreds of tons of annual demand that's essentially permanent. That gold is going into vaults and staying there. Add to that investment demand, which tends to pick up as prices rise and more investors recognize the trend. Add jewelry demand, which remains strong in key markets like India and China. Add industrial demand, which is growing as gold finds new applications in electronics and other technologies. On the supply side, you have mining production that's essentially flat. You have recycling that's modest at current prices. And you have existing stocks, much of which is locked up in central bank vaults or jewelry or long-term investment holdings. The math doesn't work. Demand exceeds supply. And when demand exceeds supply in any market, prices rise until equilibrium is restored. The question isn't whether gold prices will rise. The question is how much and how fast. And that depends on how quickly the broader market recognizes what's happening. If recognition comes slowly, prices will grind higher over years. If recognition comes quickly, if there's a catalyst that suddenly makes everyone aware of the supply-demand imbalance, prices could spike dramatically in a short period. What could that catalyst be? A currency crisis in a major economy. A geopolitical event that shakes confidence in the dollar system. A sovereign debt default. A banking crisis. Any number of things could trigger a rush into gold. And when that rush comes, the central banks will already be positioned. They'll have accumulated their gold at prices that, in hindsight, will look incredibly cheap. The individual investors who waited, who debated, who listened to advisors telling them gold is a relic, they'll be buying at much higher prices. That's how major market shifts work. The smart money positions early. The retail money chases performance. And by the time everyone agrees that gold is the place to be, the opportunity for outsized gains has passed. We're still in the early stages of this shift. Gold has moved higher, but it hasn't broken out to new all-time highs in a sustained way. It hasn't captured mainstream attention. It's still largely ignored by the financial media and dismissed by many traditional advisors. That's actually the opportunity. When an asset is being accumulated by the smartest players in the market, but hasn't yet captured mainstream attention, that's when the risk-reward is most favorable. Central banks are sending a signal. They're telling us, through their actions, that they see risks in the current monetary system. They see the need for a neutral reserve asset that can't be debased or frozen or sanctioned. They see gold as essential to their reserve portfolios going forward. Are you listening to that signal? Or are you going to wait until everyone else figures it out and prices have already moved significantly higher? The choice is yours. But understand what's happening? This isn't speculation. This isn't a gamble. This is a fundamental shift in how the official sector views gold's role in the global monetary system. And that shift has profound implications for prices going forward. Central banks are hoarding gold. They're doing it quietly, systematically, and persistently. They're draining physical metal from the market and locking it away in vaults. They're creating a supply-demand imbalance that will eventually have to resolve through higher prices. The signal has been sent. The question is whether you're going to act on it, or whether you're going to wait until it's too late.